good morning, everybody. Sorry for the delay. My mistake. Got the wrong link. Then we will start with the presentation, and we get the honor to have Mr. DK Agarwal, CEO of the IVL Group, along with our head, Mr. Vikash, to join us today in order to answer the questions that probably you may have in order to for the concerns and the risk, and as well as the opportunity for the IVL in the next few quarters. Then the session would be in the question and answer that I hope that would be the question that you may have. And then anyone who have a question along our presentation, anyone can send us a question, and then I will ask the question on behalf of you guys. Then hi, good morning, Mr. Agarwal. I will start with the first question. That probably the most concerned question for the investor today. That would be after the OPEC cut the production, and then you see the gas price now spike again, go up again yesterday. So what would be exactly the impact and the strategy that IVL will implement in order to mitigate the impact of the gas price hike over the next several quarters? Please explain to us.
Yeah, thank you, Mr.Suwat. I think OPEC's news of 2 million barrels cut of production. Well, high crude oil prices is always positive because we make from shale gas. Our the MTB margins have started spiking up day before yesterday already. So we saw the MTB prices coming down, and then we saw the margins going up. Coming to your question of gas, certainly there is a lot of volatility in the gas in Europe, and this slide shows you that, I mean, we have to understand the overall EBITDA of IVL is about 12.7% of the European. It constitutes 12.7% of the overall EBITDA of IVL. We have plant in Spain and Portugal. We have plant in Lithuania and Poland, Netherlands and Germany. We have been very systematically hedging the gas from last year when the fourth quarter this gas started going up. Actually, it was even before the Ukraine crisis. If you see first, let us address the availability of the gas, because that's one question. So you can see that Spain and Portugal constitutes 4% of IVL EBITDA and 28% of EU. The most of the gas comes there from LNG imports and from North Africa via pipelines, so there is no issue about the availability of the gas in these areas. Similarly, Lithuania and Poland, which constitutes 3% of IVL EBITDA or 24% of EU, is already, being the Baltic state, having different situation with Russia for a historical region, have been always dependent on LNG and other resources. Of course, you heard about the explosion of Nord Stream pipeline yesterday, which can make another dimension in the. But Europe today is only dependent 9% from Russian gas, and Germany and Netherlands, which is vulnerable, is 3%, the 0.4% of IVL, and we are actually in Germany already looking at substituting it by gas with the oil fired, because it's a small boiler which will be ready within few months, 4 months, so that dependence will go away. The market is very volatile in Europe. Europe has taken many measures. Yesterday, you might have read about the approval on the windfall tax on renewables, profit sharing with the fossil fuel firms, on the renewable energy. I mean, this is a very big issue in Europe. The entire industry, I mean, the PET is a small industry in Europe. We talk of aluminium, we talk of glass industry. Large number of energy-intensive operations are having a significant impact. So Europeans are working very hard on it. On the right-hand side, we wanted to explain that what has been first half, and I think we talked about this in the last presentation in the quarterly earning, that 294 million has been the additional impact of energy, but we got extra margin, $858 million. So it got more than that compensated by the margin, so 1.4 billion. But I don't want to say that it doesn't have an impact. We have because if we can move to the next slide where we have impact of the gas. So if today's forward market of 150, you can see the slide that fourth quarter we are hedged 32%, third quarter we are hedged 40%, and 21% for 23 also we are hedged as far as European natural gas is concerned. US also we are hedged up to 38%, but in second quarter, quarter on quarter, there was a 27 million impact. On last year, the impact versus current year was 155. Now we may have an additional impact in third quarter of 70 to 80 million dollars, which may not be fully recovered by the margin improvement. So this is a worst scenario. In the fourth quarter, over third quarter will be only a $5 million impact. So we are keeping a very close watch on the availability as well as the pricing volatility. We are going to put, we have put surcharges, energy surcharges in next year's contracts. Actually, we are proposing that European, because it's an industry-wide problem. It's not problem of IVL, it's problem of INEOS, it's problem of everybody, that you put in the margin a gas component, which we have done in tire cord, which we have also planning to do in PTA, PET. So yes, there can be impact of $60-70 million in third quarter, which may not be fully recovered by margins. It's a very volatile situation in Europe at present, but I think our hedging strategy and the margins are able to recover. I hope I could answer your energy question. I know this is a burning question today.
Yeah, I think you answered the question, and but just a bit extended to the answer, because you have 21% hedging for the next year and 38% for the US, right? How would the next year margin look like? Because once a year you normally will increase your contract volume margin, right? And then how would you expect that margin increase would, let's say, offset the impact of the gas cost? Because I would expect that the gas cost in Europe and in North America, let's say TTF would be €200, while the Henley Hub would be, say, $8. How would that be impacting your company under that assumption? $8 and 200.
So right now it is 160, and we have been continuously hedging. US also we have hedged, as you see, 38%. So let us talk about our contract for next year, because that is very important question which you raised. How does the margin look like for the future? In US, today we have already entered 45% of the contracts, which are at better margin or same margin as last year. And what is the reason? That people are looking for security of the supply, and so it's a weighted average PTA PET margin. We are negotiating the remaining contracts, so we feel that US, Mexico, we should be able to get the pretty same margins or slightly better than last year, which is coming to PTA in United States is linked to a formula price called PPI and fuel surcharge. I don't know if we have a slide of that margin. Vikas, can we show the PTA margin slide? So that is automatically the margin goes up. It is paraxylene plus. So if the energy goes up, it goes up. If producer price index goes up, the margin goes up. In Europe, we are negotiating the contracts. The discussions are going on with the energy component. So this is the PTA margin in North America. You can see year by year how since 2019, this is over paraxylene gross margin. You can see that when BP sold their business to INEOS, it went up to $88 per ton. And then every quarter you see there is an increase, which is a factor of energy price increase as well as, so it's a formula price, and then we have a discount on top of it. So in Europe, the negotiations are going on. I think we expect that October it should be concluded. Yes, the biggest question is on the energy today. We are trying to put this energy surcharges and which will get locked in. And the question is, we have two plants in Egypt and Turkey, which are actually not impacted by that much gas and which can very well serve the European market. So that will be as a contingency plan. Also from India we can supply, but the European margins, there may be small reduction in the European margins, no doubt about it, because I also want to raise the question of freight reduction here, because the freights have come down, which has not that impact in US, but has some impact in Europe. So we are very cautiously negotiating the European contracts, and the energy component will be there. And we will continue to hedge. US, Mexico is very strong contracts are getting entered into it. Brazil also, you know, the elections are going to be over soon. And if that uncertainty goes away, that PET demand is very strong. I'd like to bring that margin chart, if you have that margin chart, because that's very important to understand the margin. Asian margins remain pretty strong. Our premiums on the market remains pretty strong. So overall demand is quite good. This is a slide which shows that if you take integrated PET EBITDA, majority comes from Americas, 48%. 22% comes from Europe and 30% comes from Asia. And American market is very consolidated, you know. Nearly 1.2 million ton is getting imported. EMEA is about 22%. And the structure of the market is that top two producers control 80% of the American market, and Far Eastern is another one. So three players control 90%. And in Europe, EU top 70%. And you can see the Chinese margin, the light blue is the Chinese margin, average of 2017 to 9 month 22, September 22, average is $251 per ton. We saw a slight drop in September, but as I see October, November, December still remain, fourth quarter is normally weak, but we see the market remaining quite strong. And you can see the IVL premium, which comes from Western and domestic footprint, which we are quite confident of it. So demand is good. Margins are Asia margins. The material is presently reasonably tight, although the freight rates have come down. China has exported more quantity, but US, Europe continue to import. So growth is quite good.
I'm not quite clear that how this picture describe that you said the premium margin that you command mainly from the Western, right? The PTA. How would that be, let's say, compared to the spot premium that we saw? Because lots of people concerned that when the spot premium that we saw have been declining or already peaked, what would be the premium margin that you still command compared to spot? Right.
So good question. I think let me explain the structure of the sale. In US, Mexico, 85% of the sale is contract. There's no spot. You know, 10% is a spot. Very small quantity is a spot. So that does not influence. So basically, the margins get locked in, and there are raw material plus. You know, and in Europe, it's 50 to 60% is raw material. Still, we are negotiating with them, so that should be the range in Europe. Asia is 100% spot. So what you saw, the Asia margin is 100% spot, which is linked to our market prices. There may be long-term contracts, but they're linked to the Asian published prices. So that's the structure, the way the contracts are structured, you know. And the US and Mexico all will get locked in Brazil. And the only vulnerability will be if the domestic, if the Chinese spreads comes down, which I don't see any reason that Chinese integrated PET spreads, because PET demand still remained quite strong because of the being F&B, food and beverage component. So the premium will remain because of our, and this also has a premium because of domestic sales, which we do, not only Europe and America, we do in India, where there's a premium because there's a 5% duty reduction. Similarly, Indonesian market, Thai market, Egyptian domestic market, Turkish market. So all that also factors into this.
Okay, so you mean that you still continue to see the premium, but more or less, but more or less would be relatively close to the spot premium market that we saw. I mean, every month. Would that be correct?
So spot premium market, you see, as I said, in United States, we never sold a quantity in a spot. 10-15% is sold. Rest is contract. We also had old contracts where the margins were low. Now the new contracts have been negotiated at higher prices. So spot has very little influence. It only has influence in Europe, about 40%, and Asia. Asia, it has a big component. So if you go back to that margin slide, Supika, can you go to the margin slide? The PTA, this premium has been increasing. You can see in 2020, it gone 21 and gone up, and 22. It has a component because we have the margins in United States, Mexico has improved, and Europe has also improved because of the import parity and the PTA. Don't forget about the PTA, because this is integrated PTA PET. I just showed you the PTA margin in US, which are very, very high, So this shows both PTA and PET, integration. So this premium should remain reasonably strong.
So say this way, because premium you command between the continent, particularly West against the Asia, would that be coming from mainly the import parity that increase, say from the higher freight, from duty, from supply chain disruption? If next year all these kind of problems are improving, so import parity would be declining, right? And then the premium margin that you command will be sharply declining, or just how would that be look like?
Very good question. So let's break into different markets. As I said, US, Europe, US and Mexico, it will remain same or slightly better, because there's a lag of the contract. Like in 21, we could not get the full benefit. 22, we could not benefit. In Europe, yes. If the freight goes down in Europe, it may have impact in the European profitability. Asia doesn't make any impact, because Asia, we pass on the freight. Higher was the freight, we could pass on higher, and lower is the freight in that. So only the vulnerability will be in the European market because of the import parity. Yes, next year, 23, if the freight crashes, then naturally it will have impact in 24, but not in 23 for US and Mexico. Because US, Mexico, most of the contracts, as I said, 45% are locked in, some are still under negotiation. But yes, Europe, there may be some impact coming in. So this premium may narrow down slightly, but not drastically reduce. As the word drastic is quite big, Maybe it may be interesting to go for that earning stream slide, Vikas. So because which can show you that how much is the earnings breakup. Vikas, can you go to that slide? So today IVL has not only combined PET; it has many revenue stream, right? And you see this geographical diversity. We have 45 countries, and Americas is 34%, and you can see how much geographically diversified. And the 70%, 75% of our product serves the daily necessity, because another your question may be what happens if recession comes in and what happens. Food and beverages are 65%. Now, what is happening in food and beverage? Nobody cuts on eating and drinking, correct? You saw the results of Pepsi, Coca-Cola, or Procter & Gamble. All these are very strong. Home and personal care, which is surfactant business, and the hygiene like diapers. I mean, you don't cut on diapers, right? Which is 11%, or fem care products, 11%, and agriculture is about 3%, which is also very, very strong, ag chem, because today prices of agriculture commodities are so high that surfactant demand is very strong. So I would say 75% of our product line daily necessities serve. The remaining ONG, oil and gas, 5%. Now this can be volatile depending on the oil price, but you saw the recent. What is oil and gas? We make surfactants which improves to recover the oil from the well, and that's why oil and gas is 5%. The remaining auto, construction, apparel, yes, they can be affected by the recessionary condition. So 75% of the $20 billion today revenue is basically, I would say, recession proof because of the products which we make. The right hand side, I just wanted to give EBITDA per ton. This is a pro forma EBITDA per ton. This means that if we had all these plants, including Oxiteno, acquired since 18, so we did the pro forma consolidation, and we said that what sort of EBITDA per ton is it is. It averaged from 18 to 22. If the same portfolio of assets we had will make $130 per ton, including 2020, because 2020 was pretty bad. As you know, the oil price was terribly bad because of COVID. And if I exclude 2020, it is $140 per ton. So the variability of the earning is only 18%. And I think it is much different than a typical petchem company. A petrochemical company, if you take any petchem company in the world today, is heavily influenced because of polyethylene, polypropylene margin, or they are in refining, they are aromatic. Their variability will be much higher. And that's what we wanted to explain, that the variability of our EBITDA per ton is quite low. And so geographical diversity, multiple earning streams, and high level of integration provide this earning stability. And another important thing is the integration level which we have, that how much we are integrated upstream and the value chain margin is 83%. This 81% and 41% MEG integration and 20% is paraxylene. I don't want to be in paraxylene business because paraxylene is the business of refinery, because they have to have byproducts processing. So we only make in United States PX what we bought from British Petroleum, and ethylene integration is 53%. So I'm a buyer of ethylene, and not bad to be buyer of ethylene today in United States when it is cheap. If you see the next slide, just to complete on this topic. So these are the volumes on the left hand side, and the right hand side is the core EBITDA breakdown. Now you see how many revenue streams we have, and the highlighted point here is that we have a lot of stable businesses, like top 20, the top bucket is downstream, 20% constitutes 38% of the EBITDA, 20% of the volume. What it includes basically is the downstream, which is the Oxiteno IOD business, plus the Oxiteno business, excluding the commodities. So this is a very, very solid business here. Here is not influenced by commodity prices. These are influenced by value pricing. So 20% of this product has 38% of the EBITDA. 37% of the volume which comes from European integrated PET and Americas is a special position. A special position, this means we have a leadership position in the market. Although you can see Europe, 18% volume only constituted 8% of the EBITDA for 2022 because of high energy prices and all those factors which we had. And Americas, 19% volume is constituting 26% of the, and this is rock solid, because as I just told you, the margins are pretty strong and contracts have been locked in. What you see in commodities, that's where the variation is. 43% of my volumes come from commodities. And what do we classify as commodities? MEG, MTB? Well, that has been a terrible. MEG has been very much below the cost. MEG margins are terrible today because of the COVID lockdown in China. Polyester demand is bad. And this, what you see, entire profitability has come from MTB. if you break this into MEG and MTB. So 8% constitutes 7%, and lifestyle fiber, because of China coke down, is 7 to 4%. And when we look at Asia, PET Asia, which is we take as a commodity, it's 27 to 18%. So it gives you some idea that geographical diversity which we have, and we have much less variability. Why less variability in earning? Because of the product portfolio which we have and the positions which we have in the downstream business, where we have pricing power, where we can value price, and particularly Oxiteno has added a lot of value into that. And you can see in the right hand side end market like food and beverage 60%, home and personal 11%, and what you just explained. So our diversified earning actually shows the resiliency of the earning. I mean, this was what I wanted to cover. Sorry, Suwat, I went to a different tandem, but I hope I answered your question.
Yeah. So I would say simply like that. You say that let's say about almost 60% of your volume is actually generating almost 70% plus of your
2% of the
right?
Yeah.
And
Exactly.
you say that basically those are the very sustainable because of the low demand elasticity, because of the necessity nature of the products, and because of the integration that you have, right? And because of the
That's
market that you sell, right? And where is a IOD downstream? Would that be under the integrated downstream, or what exactly that means?
Yes, integrated side downstream, that's on the top, 20% constituting 38%. Integrated downstream, you see 10% volume constituting 23% EBITDA.
That's the IOD only?
IOD downstream only. Yes.
Oh, because you say integrate downstream, so I'm not sure. Would that be only?
Yeah. Sorry, they should have written IOD here. They should have written IOD, but that is the integrated downstream. Surfactants, propylene oxide, propylene glycol, linear alkyl benzene, ethylamines, all that is there, and oleochemicals, because we also have natural alcohol business.
Okay, so I think let me repeat a bit. You say in this picture, first thing, integrated PET in America and Europe, say, that would be under the contract, right? That's why it's more sustainable, correct?
More sustainable. And
in the middle
between
of
America and Europe, America is rock solid, because Europe, as I just mentioned to you, there may be some impact because of the the freight impact, because the contracts are still under negotiation. But America's is rock solid.
At least for next year, right? Because you already secure 45% of the volume, and then 55% under negotiation, and you believe that you could get, say, good margin.
Absolutely.
Okay, then I'll shift to integrated oxide, 22% of the EBITDA. Could you explain a bit more under that 23% EBITDA or 10% volume? Because how would that be sustainable?
That actually is quite sustainable. The reason is that this is a value pricing products. Surfactant, major is surfactants in Oxiteno as well as and the demand is very good, and there are contracts being entered into it, and the surfactants cut across many product lines: agriculture, ag chemicals, oil and gas, the home personal care, and coatings business. So this business is quite strong. This also have LAB. LAB today in the market is very short, linear alkyl benzene, which goes for the detergents. And then we talk of ethylamines, which is MEA, DATA. Propylene glycol is pretty strong. So this is quite, and this is the market size. I mean, you can see total home and personal care is about $23 billion business. Coatings is $3.6 billion. Crop solution is about $3.1 million. And you can see the IOD downstream, home personal care is 45%, crop solution 24%, performance products 11%. So, and we have products which are not linked to commodity margins. They are linked to value pricing, where you have the power of pricing. What is the alternative for the customers? Because we give customer solutions in this. This is totally a very high value added products. You can see most of quite a significant portion of it.
So,
can you go back?
Yeah, go ahead.
Yeah, sorry. No, I just wanted to show you the previous slide because you were trying to concentrate on that earnings slide. Yeah, go ahead.
So, would that mean that the surfactants and together with the Western PET PTA combined along with some specialty and some fiber together, you believe that it could be very sustainable and could generate, say, annual EBITDA over 2 billion? Would that be correct? Because that about 70% of your annual EBITDA.
Absolutely. You are talking of 2 billion, yes. Yeah, on this portion of the business, right? Yeah. And there will be synergy impact in this also, but yes, in that range. But don't get that commodities won't make any money, correct? Commodities will make money.
No money from commodity.
Commodities are good to have. MTB, I was surprised yesterday, day before yesterday. Normally, fourth quarter MTB is weak, but MTB margins are going up because butane prices have come down and gasoline price has again gone up. Octane is short again. So fourth quarter we are seeing in October now margins going up. So, and MEG is terrible. So we faced negative margin in MEG and people are cutting MEG production. So yeah.
Okay. So how about the ethane cracker?
So cracker margins are not good today. What is happening in ethane cracker today is that we have two crackers, which basically were in Port Neches and Lake Charles, but margins are right now zero. It's a zero EBITDA or negative EBITDA business this year. What is the reason of this situation present in is also due to China lockdown. You have seen the polyethylene margins have collapsed because China is not importing much polyethylene. So US cracker, a lot of capacity got added, and they are the most efficient because of shale gas versus naphtha gas, naphtha-based cracker. And you have seen naphtha-based crackers profitability has also come down significantly. So the ethylene price in United States is only $500 today. And that's why the crackers are not making money and the gas price went up, right? And your ethane price is linked to the gas price. So basically the crack margins are negative. Now that situation is also not going to remain because you invest nearly $2,500 per ton of capacity to build a cracker. So this will come back. Now all capex has slowed down in America. No more new capexes are coming. If it takes, so maybe 23 is bad. I assume that if 23 is bad, then 24 will be rock solid again. You know, it will go up. I always say commodities are either short or long. They are not in between, you know, that you have, and that is the situation presently. So we are running the cracker, Lake Charles, but we have optimized. We are running at 60% because the margins are not great. But technically, everything is resolved very well now. But cracker has not contributed any EBITDA in 22, rather negative.
Where is ethane cracker? I think you have two, right? One you acquire from Huntsman, I think, and one you already have on yourself, about 0.44 million tons. Where is that in the chart?
Okay, very good. So it is part of the integrated downstream to the extent ethylene is used there, and integrated MEG to the extent it is used. So we are not showing ethylene margin separately, but we split that EBITDA. But as I told you, it's a zero or negative EBITDA.
Oh, so it's under the MEG, right?
Under MEG, to the extent ethylene is used in MEG, to the extent ethylene is used in downstream, in the downstream. Yeah.
Okay.
So it is negatively impacted the downstream a little bit because of lower crack margin. But that contribution is small. You know. In Oxiteno, we buy ethylene, as you know. 100% of the ethylene is bought by us from Brussels.
Oh, so it seems that your EBITDA could be sustainable at least 2 billion plus a year, right? According to your presentation, and how the downstream specialty outlook could be better or worse next year under the global recession and under the the mega trend of more, hygiene or something like that. How you explain that way?
Right. Let's go to the downstream slide, market slide. I think that's a good question. That what is the sustainability of this downstream business? There are, as I said, 4 or 5 components. You can see home and personal care is about 45%. People don't cut on shampoos. People don't cut on, toiletries and all that, right? Home and personal care is very important. People may cut on cosmetics, expensive cosmetics, maybe Estee Lauder and all that, but don't cut on normal home and personal care. Crop solution is 24%. Crop solutions, what does the surfactant do? They spray your insecticides, herbicide uniformly on the leaves and they kill the weeds, correct? So you want to improve the productivity in the present agriculture shortage. So actually there is a very good demand on the crop, and I don't see this easing out. Performance products are good, very good in the other categories, resources. Coatings, yes, coatings, if the paint industry get impacted, because of the construction, there can be some poor demand in coatings. But that's a very small percentage. And you can see the bottom here, the home and personal care is the biggest market, 23 billion. Coatings is about 3.6 billion. And crop solutions 1.3 million, and we have a unique position in this, and this shows you the revenue. But if you put EBITDA, you will see that crop solution gives them very much high EBITDA, and home and personal cares comparatively lower, because we have very, very special products for customers like Bayer, Monsanto, Syngenta, all these. And IOD today is a $3 billion revenue business, and this is a 750 to 800 million EBITDA business today, with 18 industrial units across the world and 11 R&D centers. And there's a lot of R&D involved into this. So we have a lot of pipelines of the new products coming out. And you can see it's not like a PET where you have less number of SKUs. We sell about 2,000 plus products in the IOD business,
Could you explain a bit more? What is a crop solution exactly?
So crop solutions is, we make special formulation for Bayer or the Syngenta, the large, insecticides, herbicides companies, correct? What a farmer is interested to improve the yield per hectare, right? And that comes from good fertilizer, good, which can kill the insects and the herbicides, and which grows them properly. So this, on the leaves, the surfactant makes insecticide stay. That is the role of surfactant. And so we make very, very specialized project which improves. And remember, Brazil is a big agriculture economy, and also in the US. So that is the crop solutions. Crop solution is improving. And today when the wheat prices are going up, or all other agriculture commodity prices are going up, it's very, very important for them to improve the yield per hectare. That is the crop solution.
Oh, I didn't know this one, because normally you not mention that very clearly, and it's actually 24% of your revenue. 24%
of IOD downstream revenue.
That basically from IOD downstream, right? Surfactant, right?
Yeah, surfactant.
Oh, okay. Interesting.
So it's a very important business, and where we have a pricing power, multi-year contracts, high margin businesses. That's what is reflecting in your Oxiteno profitability. Do you have an Oxiteno slide, Vikas? Maybe that can show you how the Oxiteno profitability. That's a good question. So here is more, and that's why we see the less variability in the earning, which you saw in the previous slide of EBITDA per ton, combined EBITDA per ton of IVL. So this is the IOD segment development, 19 to 22. I mean, this is all a roller coaster ride. 20, we had the acquisition of Huntsman, right? Everything went wrong, which could go wrong. Downstream still made $200 million EBITDA, but still it was impacted because of COVID, pandemic, and hurricanes. Hurricanes was the major because a lot of hurricanes disturbed the plant's production, and you saw the 85 negative was intermediates was negative. With MEG, MTB both were negative. 21 MTB margins improved, and then we had crude oil recovery, and the hurricane there was no impact, so production losses were not there. We get 378. Post Oxiteno acquisition for 9 months, we are looking at 700 to 800 million for this year, and big component is integrated downstream. And still we had a very bad MEG demand. MEG is negative in this light blue bar. It is predominantly MTB so it's a 700 to 800 million, good downstream margins, which is the more sustainable margins, and commodity margins supported by MTB but negative by MEG. Now MEG cannot remain like this because a lot of capacities got added, and the demand in China was very bad because of COVID lockdown. Now this will get resolved. So MEG may be 23, still if it is bad, but then suddenly it will improve. Average margins of MEG are very strong. So that gives you that this segment has developed with a very strong growth potential. And remember, we are only in Americas. We are the largest in Americas. We are not in Europe and Asia. And this opportunity gives us an opportunity to expand our business in this other parts of the world. We have a small plant in Australia. We have a small plant in India, but India is a large market. So it gives us a lot of growth opportunity.
I see. Could you talk about the impact of the dollar and the Thai baht or other currency that you believe that would be the impact to your portfolio?
So, we always say our EPS is dollar EPS. It's not a Thai baht EPS, right? Because most of our earning comes from dollar, correct? Dollar margins, we get dollar margins. So stronger is the dollar, it is beneficial for us. The positive is that strong dollar reduces our conversion cost in many countries, like India. It reduces in Indonesia, Thailand. Baht has become from 30 to 37. So be 20% because I have a lot of Thai baht component cost, right? Similarly, in Turkey, Brazilian real. So that benefits are significantly. And but does it exposes us to a FX loss? No. You have seen our balance sheet. We have borrowed Thai baht for investments in companies, while the working capital is all hedged. So we don't have any impact of dollar being stronger than I have a FX loss coming up in my balance sheet. So it's very positive for us. Dollar stronger, if 37 baht remains or 37.5 remains, is very positive for us. Interest rate hike is another issue, which I wanted to cover in the slide, is that 62% is fixed and our interest rate is 3.4%. Remaining 38%, yes, it depends on how which is borrowed in baht, dollar, euro, how it may have some impact on but 62% is hedged. And we've also borrowed substantially sustainability linked 20% of the net debt, which has a lower cost. So to answer your question, stronger dollar is very helpful for us. Doesn't impact.
So let's say benefit. Let's say $1 stronger against Thai baht. How would that be translated into your financial?
So net earning, if I'm core earnings 300 million or $400 million, $350 million. If 1 baht or 2 baht is straight with 700 million baht, right? Translation plus my conversion cost saving. So I don't have often number, but it should be 800, 900 million baht. 1 baht will be 400 million at least. Or because you have the number, is anything baht weaker?
Yeah. So if the dollar is stronger by, let's say, 1%, so if dollar is stronger against baht and other currency, so our conversion cost will improve by $5 to $6 million per annum.
You mean lower?
Lower, yeah. It will get lower.
This is for global, right? Global production.
Global. Yeah.
I
So
see.
1% strength in dollars is about $5 to $6 million improvement in our cost.
Yeah.
Down.
Maybe we can give $1 million and then translation gain of Thai baht earning, right? That is, that if I have annual earning of, I'm talking of quarterly earning, you know.
So you're on your profit side, you also benefit, right? On the cost side, you already mentioned. Revenue side.
Yes. So we benefit from revenue, we benefit from cost. So EBITDA increases in baht terms and net profit will increase, correct? Because interest component is also in baht on the Thai baht borrowing, right? And euro borrowing is a euro interest rate. So it will also benefit in interest.
Okay. So we come to close to the time. Maybe I'll go to probably a question about the recyclability again, and maybe you can explain that how you can enhance your competitiveness, say, or preference to your customer in terms of that.
Absolutely. So sustainability has been at the heart of IVL, and this is highly recyclable product. Can we bring that slide which shows comparison with different plastics? You know, today in the world, PET is 100% recyclable. About 55% is recyclable. I mean, this slide shows you why PET is preferred over aluminum and glass, but this shows you what is previous plastics, all the plastics. If you turn the bottle, any plastic bottle, you will see this number 1, 2, 3, 4, 5, 6. Then you can make up that whether it is PET bottle or it is high density polyethylene bottle, any bottle in the market you buy, you will see on the back. PET is 100% recyclable and has stood out to be the best. And 55% is the recycle rate. This means it's collected rate, and this is going to continue to improve. And high density polyethylene is about 30%, but more expensive to recycle. PVC is and polystyrene is there. So what is happening that there is a shift of some application where functionality can be met to PET, and PET is getting the market share. We saw this in thermoforming in a big way, packed foods, you know, eggs, meat packing, all that. When you go to the shopping mall and you see the those food packed or salad packed, that demand in China went up by 45% 2 years back. Just another hygiene reason. So PET, that is the reason PET demand is not linked to GDP. I mean, 2020 GDP was negative, but it was positive growth for us, and that's why we say it's a recession proof. If you see per capita income, per capita consumption, and then we can go to recycling. Can you go to the per capita slide? Yeah. So per capita consumption of PET is still very low in developing world. Now this is the slide which shows you that, like India is still 1 kilo, but very large population, while in North America is 11 kilos. So you can see 1 kilo, 11 kilo, China is about 5. So this PET per capita average is about quite low. It's about 2.5 kilos, in the emerging markets. So that's why this growth is coming because of in the emerging markets. Nigeria had a 15% growth. So whatever you see in the bottom left, so a lot of potential to grow. And then on top of it, we are having this substitution, like glass getting substituted by PET, juice getting done, yogurt cups which are from polystyrene getting converted, LDP milk bottles, there is a lot of work going on. Beer is still not there yet, because beer people like to use glass bottle, but except for the stadiums. On the recycling, we committed about 750,000 tons of recycling investment. We have, what is our strategy in recycling? We are buying small assets around the world and scaling them up. So this is a journey in which we are. We have already committed, we can go to the recycling slide, about 500 KT plus. Demand of recycling is very good because our customers have made very strong commitments to have recycled content. Pepsi, Coca-Cola, Procter & Gamble, all of them. And they are entering into multi-year contract. Here, the pricing is done based on bale price plus margin. So it's a fixed margin business, you know, and which should create, once we have scaled up, 12 to 15% ROCE, which in 2022, you can say it's not contributed much because we are still scaling up the plants. And the present capacity is 345,000, which committed is about 500. You can see everywhere in the world we have. In Philippines, we have a joint venture with Coca-Cola. India, we made a recent acquisition. Thailand and Saraburi, we are double the capacity. In Nakornpathom. And Europe and France, we just commissioned a very large plant, and subsidies have been obtained. Poland. So this is a journey of making investments right now, where the returns will come in 23-24. You know, as we complete all the projects. Our vision 2030, we have said that 750 will make 1.5 million ton, and we are actually getting a lot of attention from all the brand owners because of these commitments which we are making and the investments which we are making, which leverages. So I have no doubt that this recycling business will continue to grow. PET in Thailand also, now we got the approval. The final approval is awaited. It's basically they don't allow at present bottle to bottle, but ministry and with the university study it is allowed. It's going to be allowed very soon. So then we will have in Thailand also recycled PET. India is also allowed recently. So this is a very high growth business, I could say, and it will become a very profitable business and helps in our virgin business.
Okay, so probably final remark because we have run out of time. Maybe I'll summary a bit, and then maybe you can summarize the point to end the session. I think that you have a margin structure, the market structure, or the business portfolio structure that you believe that could make, say, 2 billion plus EBITDA annually. And then out of that, roughly quarterly, you could probably make, I would say, roughly about 10 billion earning, more or less. And would that be fair enough to say? If not, can you explain and you probably give the final remark to end the session?
Thank you, Suwat, for arranging this conference. It's very important. I mean, the businesses in which we are, there is less volatility. I think let's not compare us with the refineries. Let's not compare it with this high density polyethylene or polypropylene where the margins go up and the margins collapse. You know, our variability you saw is very less. And I know market always thinks about what is the volatility in earning, and that's what the multiple comes in. So it's a different company altogether. Your assumption of 2 billion is, I would say, a conservative estimate. But yes, that should be no reason why that should not happen because of our diversity in the earning, the leadership position which we have in the business around the world. I mean, don't underestimate 20% market share in the world. It's a big power. and largest player of the the surfactants in Americas with a growth opportunity. We have a lot of growth opportunities. We have made so many acquisitions around the world. It's easy to make acquisition, but we have integrated them so well in the business, and we have a lot of talent with us, which gives us growth opportunities. And probably this bad cycle may be a good opportunity to acquire at very good prices when the interest rates are up. Private equities are staying away from the market. Their WACC has gone up. So it's a great growth story. I mean, we are a growth stock. We are not a dividend yield stock only. And a dividend yield is also good. I mean, we think that will give good dividends with all the earnings which we are having announced the first quarter increase, and will give quarterly dividend. So, and over the cycles, we have given a very disciplined approach to the return through the cycles, and we are very careful on our acquisitions. We look at many acquisitions and then conclude one. Oxiteno is a very good example. We acquired the business for $1.3 billion. This year, probably we'll make $280 million EBITDA. I mean, we thought it will be 6 multiple, but it's running, and this is pre-synergy. The synergy is going to be another $100 million. So it's a very diversified company with many revenue streams, not exposed to that cyclicity which a typical company has, particularly a mining company or any company which has a lot of cyclicity, or a banking stock where recession comes in, it hits you with NPLs and all that, right? Our product lines are more exposed to the daily necessities. So we are very confident that we'll continue to grow our business and deliver the bottom line.
Okay. Thank you very much, and I hope that this session will be useful for anybody who come and join. And thank you, Vikas and DK Agarwal, for today. And
Sure.
I hope that we see the performance next quarter, and you guys can prove. Okay, thank you. Bye bye.
Thank you very much. Thank you for arranging this.
Thank you very much. Bye.
Bye.